Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Mihir, welcome to the Investor Hour. I was delighted to have you here on the show. So let's kick this off. We have a lot of ground to cover, and there are a whole bunch of things that are on my list to talk about. But most critical of all, I would like to start with really the start, in the sense, where did you grow up? Where did you study? And also things like, how was the environment in your home in terms of were your parents investors? Did you have those IPO forms coming by mail in your house? A little bit of background will help. Over to you.
Sure. Thank you, Rahul, for having me. It's a pleasure to be here. And, it's a kind of it's up, you can say afternoon on a holiday. So it's more relaxed and nice to chat with you to that extent. So my background is really, very, so to say, typical, the middle class background. I grew up in a town city called Baroda. Now it was a town, now it's become a city. Well known for its, colleges and education and culture. Good mix of, the local population, of course, which is the Gujaratis, but it also has the history of the Marathi king Gaikwads. So there's a nice, palace, and there's a bit of a Marathi cultural element also in the city's heritage, so to say. So it was a good, I would say, cosmopolitan environment to grow up in. More so in my case, because I grew up in a township, which is the township of the Gujarat State Fertilizers Company. And that was one of the very initial set of, temples of modern India, so to say, which Nehru envisaged in the public sector. And so the fertilizer factory and the ammonia plants, etc., were the first amongst the first in the country. And to that extent, we had engineers from all over India. We had, the staff, the employees were from all over India. So, it was a good, very healthy cosmopolitan atmosphere. We had our own school, again, like the typical, the township that you see in the government run. But so it was a very well-rounded experience. We got facilities, for example, which were unheard of at that point in time. A beautiful club and a swimming pool, which belonged to the township. So nice, very, wholesome, I would say, raising. And then, of course, we, from the township, as we grew up, we moved to the city in our own home, which my dad bought. And that was a bit of a different experience. But again, a typical small town kind of environment. So that's where I come from. Parents, again, as I said, my mother was a homemaker, and father used to work with the state government undertaking, which is GSFC. And so to that extent, the money was, not like in abundance, but it was enough to live a comfortable life. But I had a couple of uncles who were quite into investing and all. So sometimes they used to kind of, encourage me to kind of look at stuff. One of my uncles was very well read, so he used to keep sending me copies of magazines that he had already read, the business magazines, etc. So my exposure actually came from there. And that was one uncle who I used to respect a lot. Again, very well educated, very well read. So he used to keep sending me books to read. He used to keep sending me magazines that he subscribed to, like Business India, Business Today, The Last Street, those kind of magazines. And I used to read the older copies, month-old copies or 15-day-old copies of what he used to pass on to me. So that whetted my curiosity, my appetite for learning. And I'm grateful to my dad and my uncle for that.
Wow. Was GSFC listed those days?
It was, I think. Yes, it was listed in those days. Yes.
I think if my memory serves me well, there's something about the Gujarat PSUs. They were always a cut above the rest. And there were quite a few of them, right? There was Gujarat State Fertilizer, GSFC. There was a Narmada Valley thing.
Absolutely. GNFC.
GNFC. The name slips me, but I think there were more such companies which tended to do well, I guess, for whatever reason.
Yes.
But it's pretty interesting. So you got introduced to, I guess, the world of finance and business via reading all those brilliant magazines. Business India and Business Today, I think, came early 90s, very early 90s.
That's right.
The first edition.
It predominantly used to be Business India was the one. India Today.
Wall Street. Yeah.
Wall Street Journal, Business, India Today, of course, for general knowledge, so to say. And then he used to have those international magazines also, Time, Newsweek. So I used to read those back copies of those.
Do you recollect having tried your hand at something those days or making a mental note of a stock which you liked?
No, so what I used to do is my uncle used to make me fill forms of the IPOs for himself, because that time they used to do many applications. There were multiple applications across different folios and all. So I used to help him out sometimes to fill up the applications. And he used to also kind of nudge me towards it, because then I used to go to the bank to deposit the IPO applications. So I got some exposure, not on my money, but at least I got in touch with the markets, in my college days because of that.
That's good exposure. Yeah, you get to see how the process works in itself is a good learning.
Absolutely.
You remember any form you filled? I'm just trying to get some names out. This would be the 80s, I would assume. Late 80s?
So, in fact, for some weird reason, Baroda used to be a big market for many of these unscrupulous IPOs at that time.
Mhm.
So, I remember a few names which don't not very easily recollect. But one of the big IPOs I remember in the early 90s or late 80s was Tata Timken.
Mhm.
And Tata Timken was a blockbuster IPO in the late 80s or very early 90s. It was 89 or 90 or somewhere around that. But that got oversubscribed. I remember at that time like 400 times, and it was a big thing. So that's one thing that I distinctly remember. Then there were a couple of eyewear companies that I remember being listed from Gujarat, but those were the Dabba companies which basically floated for the
That
sake of.
Indian financial history is littered
Yes.
with Dabba IPOs.
Yes. And for some reason, Ahmedabad, Rajkot, Baroda, and Jaipur used to be the hot hubs of these IPOs. I
That's
remember that. Yes,
It's probably true a little less today, but still a little bit true of those places, right?
absolutely.
And so at some point in time, you went, I did check up your LinkedIn page. You went to IIM Lucknow to study.
Yes.
And then what I found pretty interesting is typically when I'm talking to people on my podcast, they usually become analysts and they go through a process and become fund managers. At least from your LinkedIn profile, it seemed that when you came back from IIM, you straight joined as a fund manager in one of the AMCs. Did I read that right?
Yeah. So it was like I did my MBA from IIM Lucknow after my engineering.
Okay.
And coincidentally, after my engineering, I worked with GSFC again for a year. And of course, while I was working, I've also parallelly, started preparing for the CAT and stuff like that, and then got into IIM. So I could not work for more than a year because I got into IIM Lucknow. So the way it worked is that SBI mutual fund did not exist independently at that point in time. It was a part of SBI Capital Markets, which was the merchant banking arm. So SBI Capital Markets used to come to campus to recruit. So I got a placement in SBI Capital Markets, and then they said you're going to be placed in SBI Mutual Fund. So that's how I joined the SBI Mutual Fund. And this was like 1994, where there were only public sector mutual funds. If you remember, the first private sector mutual funds actually were licensed out in 1994 itself. So they did
Morgan
not
Stanley is 1994, if I'm not mistaken. That's when it
Exactly.
launched. Yeah.
Exactly. And then 93, 94 is when there were all these Birla Mutual Fund and, Franklin Mutual Fund, Morgan Stanley, all the first, the Reliance Mutual Fund. They were in the process of getting set up. They hadn't really set up at that point in time.
Yeah.
So pretty much at that point in time, UTI, of course, was the big daddy, but not technically a mutual fund because it was under the UTI Act. And then it converted to a AMC later on. So in the first breed of mutual funds, if I remember correctly, it was the public sector bank sponsored mutual funds, SBI Mutual Fund, Can Bank Mutual Fund, Indian Bank Mutual Fund. Those were the first breed of mutual funds to come in, and basically they were staffed with the people from the bank and people like us who were freshers. So it was learn as you go. So everybody used to kind of dabble in everything, so to say. So I started out as an analyst, but very quickly, when we decided to launch a fund in 1995, I joined one of the senior fund managers as his assistant, and we launched the first open-ended mutual fund in the country for SBI Mutual Fund, which at that point in time, at that point in time, we didn't know what to call it, so we just call it Magnum Open Fund. So because it was the first open-ended fund, so to say. So that's how it was really learning.
Very interesting. So you joined SBI Capital Markets in 1994. That's about a year and a half after the Harshad Mehta scam had happened, or Harshad Mehta meltdown, post Harshad Mehta meltdown had happened.
Absolutely.
Everything had got wiped off. But the markets now were once again kind of rallying to this whole FII money coming in.
Yes.
And all this buzz around these private sector funds, Morgan Stanley Growth Fund, people queuing up for kilometers to get a form, etc., etc. So, how was it like when you entered? Because I'm assuming when you were studying, you were probably reading all about the collapse. But by the time you joined SBI, the bull market was like on,
Yeah, absolutely. The Sensex at that time, I remember in May 1994, had touched 4,500. 4,545 was the level, which was actually a new high at that point in time. And of course, after that, it went down. But you're right, the Harshad Mehta scam was pretty much past us. And as you correctly mentioned, it was the first wave of FII money coming into the country. In fact, in SBI Mutual Fund, we had set up just a couple of years before 1994, we had set up a fund called India Magnum Fund in collaboration with Morgan Stanley. So that was amongst the first breed of offshore money coming into India, jointly managed by SBI and Morgan Stanley. And then, of course, Morgan Stanley started their own business in India. But those were the exciting times of the first wave of opening up. First wave of post Manmohan Singh opening up money coming into the country. So those were kind of pioneering times to a great extent. In fact, I think whoever has joined the market around 1990 to 1994, 95 has actually, even if you did nothing, you just got carried, and your career progression was very nice without much effort, because there was no talent in this field available at that point in time. So if you look at all the leading fund managers offshore or within India, a lot of them are in the 1990s.
That's right. That's right. That's right.
And
But
the
there
other
was a lot of
exciting-
effort. Yeah.
Yeah.
You're being humble. There was a lot of effort required
Yeah.
to get that.
Yeah, but you just needed to survive, because you also must, just to step back into history. In 1994, as I said, the Sensex was 4,500, right? And it had gone up in the last since 92 onwards, when the market had bottomed. Then it went up consistently on the back of optimism that Manmohan Singh is doing the right things, India is globalizing, so foreigners are coming in, etc. But that actually was an intermediate peak. So 1994, when I joined the mutual fund industry, the Sensex was at 4,500. And 8 years later, in 2002, if you remember, the Sensex actually bottomed at 2,800.
Yeah.
So, so it was 8 years of actually no returns in the first part of my career. So that's also actually been a bit of a learning, and that also probably shaped some of my investment decisions even at this point in time.
Yeah. So if I recollect well, so 94 you had the FII peak.
Yes.
I think 95, 96 you had the IPO peak.
Yes.
Then 99, 2000 you of course had the TMT peak. So
before that, you had the uptake again in 1998, but then we had the Asian crisis.
Yeah. Okay. The August 98 was when Russia melted down, and that's when it all ended, I guess.
Meltdown happened. So the global markets also corrected, or especially a lot of emerging markets. And because emerging markets collapsed, big fund, if you remember LTCM.
Yeah, long-term capital management. Yeah.
So that collapsed. And because LTCM collapsed, Greenspan cut rates aggressively. And that aggressive rate cut actually fueled the TMT boom.
Yeah. Sounds kind of familiar. Rate cuts and booms in markets.
Exactly. Yeah. History repeats itself. Yes.
Yeah, it's amazing. So so that was quite a tumultuous period, right? You had multiple, every few years you had a boom bust, and that's why for many years after 90, retail investor never really came back. Yes. Because they just lost trust in the market. So in this whole process, now talking about you specifically, when did you make your first investment in this whole period? And if you can tell us more about what that investment was.
So my first investment, I think, was in one of the
IPOs. How was it, an IPO?
No, it was in let's just say it didn't go well. You never really learn till you put in your own money, right?
Yeah, that's true. Yeah. So that's the other common thing amongst, you mentioned one common thing is that a lot of fund managers started that time. The other common thing is a lot of them lost a lot of money in stocks those days. Yeah.
Exactly.
Very few actually.
It was a petrochemicals company, newly listed. Of course, at that point in time, chemical prices were going up, so it was all the rage and all. But obviously, you didn't sell. You got some shares allotted, but you didn't sell. It all went down to zero.
So you paid the fee to learn.
Yes.
What mistake not to make, and a small amount because you're starting off. Uh, so, talking about a little bit more about investment. So of course, you were on a path to being a fund manager and managing money, etc. And in parallel, you were doing, you're growing up as an investor yourself. So I'm trying to find the key learnings and the experiences you had in this period, the 95 IPO period, and of course the 99 2000 TMT period. If you can share a few of your experiences those days, or what you did with money, or how the funds performed, and how you dealt with that.
Sure. So the good thing about being a fund manager or an analyst at that point in time was that you didn't need to be a great analyst or a great fund manager to do well. Even if you were curious enough to just read a lot and find some information, that was power. So today, you can Google virtually anything, Bloomberg, Google, Reuters. You have so much information that you actually need to process a lot of information. At that time, you just had to find information. That itself was a value addition. If you remember in the early 90s, even if you just got the price timeline of say PVC prices for the last 10 years, it was a valuable asset for you. So analysts were actually data collectors, and if an analyst could go to the textile market or through his contacts get a timeline of PVC prices or cotton yarn prices or VSF prices, he was considered to be this analyst is very well connected, he has a lot of information. So just information gathering was itself a skill, so to say. And to that extent, networking was important, personal contact was important. But now, of course, we have too much information, and processing information is more important than collecting information. So I think that one big shift that has happened. Second is I also gradually, in the 90s also realized that as you keep on reading about value investing and growth investing, I also started realizing that I am not, a person who can just buy something just because it's cheap. So that's where probably my philosophy of buying growth came about. And I was never, very impressed with stocks just because the dividend yield is 6% or something like that. Because I didn't get excited, that's my style. Then, of course, came the TMT boom and growth did very well. So my funds did very well. And then, of course, because of certain compulsions in some of the funds, I actually had to sell in 2000, which turned out to be a blessing in disguise because then that turned out to the peak. So in a way, luck also plays some portion in investing. But then in the 2000 meltdown, you also realize that buying growth is not enough. You have to be conscious about the valuations. So even in 2008, for example, when some of the big real estate IPOs were coming up, I mean, I called all the investment bankers and the analysts, asked for the spreadsheets on what basis they are valuing these real estate IPOs, because that was the first time you had real estate companies coming into the country. But because of my experience of 99, 2001, I really dug into those spreadsheets for all the real estate companies. And, I realized that for the real estate companies, for example, analysts are projecting that they will sell in 1 year the number of square footage that the company has not delivered or has delivered in the past 20 years. So if a company has delivered 5,000 apartments since 1990 to 2007, people are assuming that he's going to sell 3,000 apartments or 5,000 apartments every year for the next 10 years or 20 years. Those were the kind of assumptions that people were building in. And it didn't make sense to me. I broke my head. I had heated arguments with the analysts, etc. Didn't put money in the IPOs, and of course, felt left out also when the IPOs listed at 60-80% premium. But then, of course, they all went down by 90%. And in hindsight, I guess everybody was right. Even the bankers who said IPO is going to do well, they were right. And I was also right because they went down by 90%. Market has a place for everyone.
Yeah, I think, that's the interesting thing, right? When you are going by your conviction, and more often than not, you're going to be against the mainstream. And it really takes a lot to stand by your opinion. Like you said, you had heated arguments to try and, I guess you were trying to double check whether you got it right? In terms of your sensing.
Absolutely.
And you gave a buy. For example, if you did not buy HFCL, Z, and there's all those stocks in the earlier rallies, in the 99 2000 rally, I think everyone felt like a fool because those stocks rallied so much. But if you look point to point 3-4 years, well, you're very smart, but when the stocks are moving up, you're going to feel pretty
Absolutely.
low, I guess. But
As
you
they,
want to
as
stand
they
by your
say,
convictions.
yeah, as they say, the markets can stay irrational longer than you can stay
Be
solvent.
solvent. Yeah. That if you remember that, that's so important, right? You'll do well as an investor. So you mentioned something very interesting, which I picked up on. You said that you had loaded up on growth, but because of the policies, you had to exit in 2000. So I'm assuming you're talking about loading up on telecom, media, technology stocks, among others,
Yes,
because that was the go-go years. Everyone was betting on growth.
yes.
And tell us what happened really, and what kind of a policies, because it could teach, I guess, the viewers on how to have filters in place which sort of can prevent emotion getting the better of you as an investor.
Uh, so actually, it was the way some of the products were structured. We had these income plans where we had to generate certain assured kind of returns. At that time, mutual funds were allowed to give indicative returns, so to say. So we had some of those plans, and as luck would have it, some of the plans had gone into deficit. But then this sudden boom in '99 happened, and the deficit turned into a comfortable surplus. So then I spoke with the management and said that let's kind of capitalize on this, because we are lucky that we are not running a deficit anymore. So we kind of then started trimming booking profits aggressively in some of those funds, so that we had a ample buffer not only for this year but even for the future, and that turned out to be a good call. So I think the discipline of being satisfied with what you have, I guess, and making sure that not only this year but the next few years buffers were met. That helped, and because I was selling in some of the funds, I also took the call to sell in some of the other funds which did not really require to be done.
Yeah, so I guess what the possibly one of the learnings from this is that if you have income goals, you should try and meet them and not get too greedy just chasing the capital, right? If you have to book your profits to pay, let's say if you have a loan, right? And your goal is to never be a debtor, and you're sitting on a big capital gain and the stock markets are going up. I guess it helps to take some
First,
money out
and
and
be alone.
stick to your principles and not let the stock price drive your, how you're going to run your life. So I guess
That's good.
that kind of played out well for you, I guess.
Yeah, and then on the other hand, going by a similar example, we have many examples of employees with stock options which are not yet vested, but then there is funding available against those stock options, and people have gone ahead and taken loans against
Loans. Mm.
unvested and vested stock options, and the markets have gone the other way, and people
Yeah.
have come under stress. Yeah.
Yeah. In fact, I'm told that in March 2020, in the pandemic, when the pandemic flash crash, or if you call it, that happened, there are a lot of people who had taken such loans. They
Yes.
took a big hit because automatically all the calls were triggered or they had to liquidate.
Absolutely.
And that caused a big loss to people. But leverage, to my mind, for at least individuals, uh, I don't think there's much of a case to be levered up when you're investing.
No, absolutely.
Uh,
Not in equities for sure.
Not in equities. Yes, completely agree. Okay. So we've spoken a bit about 99 2000, the great financial crisis, 2008. Let's talk a little bit about the pandemic. Uh, and when the pandemic is hitting, you got 25 years of experience under your belt. You've been there, done that. You've got all these cumulative learnings. How were you placed on the eve of the pandemic, and how did that pan out for you?
So, just to step back again, before the pandemic hit, we were already beginning to see some signs of slowdown for India. So there was a bit of a slowdown which was creeping up. Of course, we had the demon in 2016, and then the uptick in since then. But in towards the end of 19, it did look like things were slowing down a bit. And then towards mid-February, early March, we started receiving news of this, new strain of virus, etc. And by the second week of March, it really looked serious. So we actually cut a lot of beta in the portfolio, generated a bit of cash in the portfolio by the middle of March, and suddenly the market tanked, by around around beginning of 10th of March 2020, markets started going down quite sharply. So we were quite well positioned for the downfall, I must say. We did well.
That's a great call, yeah. If you were able to cut down beta, because uh, February, yes, the news started filtering in. March, I think there was some volatility in the initial days.
Yes. So there was enough time to sell. It was not a panicky situation. So we could easily sell whatever we wanted to sell. And then, of course, things worked in March, and I think 28th March was when the bottom happened. But that's only half the story. The good part is over. Then we were still sitting on cash in April, and the market started rebounding as central banks, came out with all guns blazing, with the governments coming out all guns blazing on the fiscal side and central banks on the monetary side. So it took us almost a month and a half to get back to, because the movement was so sharp that while theoretically we could have done it in a few days, but it was so volatile that we did not take the call on one day. We kind of took a little while to get back to, more invested levels, so to say. So while we did very well in the first part, in the V-shaped recovery of the market, we lost a bit, but I guess it all evens out in the end.
Yeah, but with the benefit of hindsight, it's easy to say that you missed it. But the fact is that there was so much uncertainty at that point in time. And if you were running a low risk strategy, I think it is perfectly excusable to have been holding cash for longer than other people, because no one knew how it's going to pan out.
Yeah,
if you remember, if I hope I don't misquote that, but I remember Charlie Munger did an interview in March sometime. And so Buffett had already said that he will not be speaking before the AGM, which will be in May. Munger had spoken a little bit, and Munger said, our mission is to come out on the other side of the pandemic with more cash, or something like that, broadly what he had said.
Correct.
Basically, they were being conservative and they were selling stock because
Absolutely.
no one knew how it's going to pan out. So a lot of people may have gone long at that point in time. But if they went long, assuming they're taking more risk, it's fine. But if they went long and they did not have the appetite for risk, that was punting. They could have lost everything. If the vaccine got delayed for another 6 months, it could have
But for
been.
institutions, the decision is a bit easier because we are expected to be long only. So it's only a question of whether you have 2% cash or 10% cash.
So there's a little bit, just a small margin that you can play with.
Exactly. But it's never easy. And probably we underestimated the size of the response. Now that we have the data, of course, we realize that the balance sheet expansion that the Fed did from 2009 or 2008 to 2011, which was almost 3 to 4 years, they hiked the balance sheet by almost $3 to $4 trillion. This time around, they did it in like 9 months or 10 months. So the kind of ammunition that they used this time around was far more than that, which you realize now.
They didn't want to leave anything to chance.
Exactly.
And when they were done with it, then comes the fiscal.
Exactly.
And it was coming to early last year, right? With the Biden spends.
And now, of course, we have the inflation to pay for it.
Now we have to pay for it. So I don't know what strategy would have worked out well, but in hindsight, I guess if you were long, you were long. Yeah. So did you, in March 2020, was there any particular source or what you read that gave you the conviction that it's time to go down on beta, lever down on your beta?
No, it's just that this was an additional reason to lower beta because, as I said, there was a bit
of economy was already slowing. You were saying, yeah.
It just was a trigger to act faster, basically. Yeah.
So net, so in this whole series of these ups and downs in the market and all, how was your style of stock picking evolved? You mentioned you were a growth investor. Then you learned that you can't buy growth at any price, which you mentioned. Tell us what's the cumulative of all this learning? What is this stock picking selection process that you have evolved now?
Yeah, so I think it's all evolved into growth at a reasonable price, which is GARP, but with a strong filter of quality. And by quality, I mean the tangibles as well as intangibles. So it's not only ROE, ROC, free cash flows, but the promoter background, the management quality, the depth, the transparency, the corporate governance structures, board structures, etc. How they've treated minorities in the past, all that kind of stuff comes into the quality part of it. So I think that has become the first filter. So if you're not comfortable with the promoter and or the management, we will not look at the stock even if it looks cheap on our GARP filters. Then of course, as I said, I continue to remain a growth investor. I think in a market like India, when the nominal GDP growth rate itself is double digits, there's no point in not being a growth investor.
Just for the benefit of the viewers and listeners, when Mihir says nominal is basically real plus inflation. So if the economy is growing at 6%, that's really the real growth rate. And if inflation is 6, so 6% of real growth plus 6% of price growth, so 12% becomes the nominal growth. Just for those who don't get that. Yeah.
Absolutely. And we know that India has been historically growing at about 7% with inflation of 5 to 6%. So 12 to 13% has been the nominal growth rate over the long term for India. And I don't think it's any coincidence that if you look at the long-term EPS growth for the Nifty or the Sensex, that also happens to be around 13-14%.
Yeah.
So, in a growth economy like India, it pays to be a growth investor as long as you have the quality filters in place and as long as you keep broadly valuations in mind. And again, people make this, at least I've seen so many people confusing value and valuations. So value by value, it typically means a stock being cheap on, say, price to book, or dividend yield is very high, or PE is low. So that typically forms the value part of the market, which has its own fans and which has its own, philosophy. And then comes the valuation part, where we don't look at one parameter, but we look at multiple parameters to find the intrinsic value of the business, not the mathematical value of the business. So we're not looking at scuttlebutt investing or half price to book kind of thing. As long as we think the company is going to deliver growth, which means higher EPS going forward over the next many years. And of course, with EPS, hopefully cash flows also will accelerate. Cash flow generation will accelerate in the next few years. How do you value that? Growth.
Yeah. So an obvious question that would come to you is that when you're saying growth at reasonable price, right? A lot of the high growth companies now, which actually are getting shattered every day we speak, they don't really have earnings to speak of, right? So how do you? So basically, talk to us a little more deeper what you mean by growth at reasonable price. Absolutely. And if you can throw some names from history without talking of anything sensitive, that'll be nice to give context, make it a little more real.
Sure. So growth at a reasonable price, again, as I said, by price you mean valuation, and valuation has no fixed arithmetical formula. So for some segment or some stocks, you might use price to earnings multiple. That's typically in a normal growth stock. But as you said, there are so many of these new companies where there is value. You can't say that a fintech company with 50 million subscribers doesn't have any value, right? The question is, how do you put a value to that? All the value is in the intangibles, that is one. And all the value is in the value of the cash flows that the business will be able to generate in the future. So very crudely speaking, if I were to compare this with a greenfield project, earlier you used to have companies, let's say you are a company with no current business, you do an IPO, you raise equity money, and you buy land and plant and machinery, and you set up a steel plant, right? That plant will, first of all, take a few years to set up, let's say 3 to 4 years. That's the time you have negative cash flows, you're putting in money, equity, as well as leverage, debt. And then after 3-4 years, in the first year, you run the plant at 25% capacity. In the second year, you run the plant at 50% capacity. And third year, probably go to 100%. So from the time that you start investing till the time you reach, say, 80-90% capacity, you'll be negative cash flows. But that does not mean the plant does not have any value till the 5th year, right? So the stock price will not trade at zero, right? The stock price will trade at something because stock price is looking at 100% capacity utilization and the global steel cycle, local steel cycle after 5-7 years. that's the way to value some of these new age businesses also, that they are burning cash, but they are burning cash to generate intangible assets, which is more subscribers. And the hope is that this subscriber base will be sticky. And once you have a sticky subscriber base, you can sell, cross sell, mine that base, and then generate future cash flows. So very crudely speaking, it's a capital intensive project with future cash flows which need to be valued. So point is that you know steel prices, but you don't know what the value of a subscriber is, right?
And whether he's sticky. That's
Well,
the
and-
million dollar thing.
Exactly. So that's when you do kind of benchmarking, global comparisons, historical. Most of these fintech company models are not unique in the sense there's somebody out there in the US or Europe who's done that. In China also there are lots of comparable models. So you kind of try to derive some kind of pattern out there and use matrices which are not the normal EPS kind of matrices to arrive at a value. So far, in the IPOs, we've hardly put in any money in many of these IPOs. But, as you know, a lot of these companies have fallen a lot, 50, 60, 70%. And there is expectation that most of these IPOs, which happened a year and a half ago, have most of the lock-ins expiring in the next couple of months. So you might see some good supply. So there might be some volatility around there. But when a stock is down 60, 70, 80%, if you genuinely believe that some of these businesses will survive, then in the long term, they are likely to scale up also.
Yeah.
Which means that some of these might actually, offer some value.
I guess.
And this is the problem in valuation, not only in India, but globally. Because earlier, industry and companies used to be physical. Now, most of the businesses are not physical. All the value of Amazon, of a Google or a Microsoft is not in physical assets anymore. 90%, 95% of the value is coming from non-physical assets, intangibles. But the brand that the premium that Apple commands is because of its brand and the network and the ecosystem that Apple has made around its Apple Store and the apps and the revenue sharing that it does with the content, etc. So how to value that per subscriber is something that we'll have to get used to it, because more and more value will be created by intangibles. So you can't say as an investor, as a fund manager, I'm not comfortable valuing these companies. You have to have some kind of a framework.
Well, after all, Warren Buffett also bought Apple, right?
Exactly.
He was always into the hard economy. I always said, I don't understand tech. I don't understand this. But one fine day, he's buying Apple and he buys a ton of it. I think he's the single largest shareholder in Apple now, right?
Exactly.
Something like that. Yeah. So you are saying that in the Indian context, where you can see a long runway of growth, it makes sense to be a growth investor, but you want to be buying growth at reasonable price. And when you're talking of reasonable price, you're saying look at things like PE, for example, where there are earnings and visibility. Where there's no visibility, like let's say tech companies, then you have to figure out stickiness, etc., and try and assess whether they make sense.
Or price to book, for example, in the case of financial companies, price to book adjusted for ROE and growth.
Like the fintech, I guess fintech companies very quickly you can assess. Is that what you mean?
Even banks, we use a lot of price to book multiples. Because higher the ROE, higher the price to book, that kind of equation we have, of course, adjusted for growth and consistency. So different courses for different horses.
Yeah, and so a lot of people would swear by value investing, which is buy deeply discounted stocks and just buy and hold them forever, the Warren Buffett style, right? And I guess most of India has grown up. We were in that generation which has been primed by Buffett for all this. So when you're doing growth, talk to us a little bit about the process of ensuring that you remain on track. And are the holding periods any different? Do you need to be more actively involved to figure out that everything is on the right track when you're doing growth investing?
Actually, I think Warren Buffett is also misunderstood. People kind of pick and choose which part of
his career, the first one on the second.
Exactly. Which part of the career, which part of Graham and Dodd,
Yeah.
So I think it's all over the place. So, but I look at growth because I like to see visible earnings triggers or earnings, drivers, sort of, not only drivers but triggers. So, for example, if a bank is growing at 25% for the last 4 quarters and there's nothing that has changed, and if you assume that it's going to grow at 20-25% for the next 5 years, then you value it appropriately.
Yeah.
But if you think it's a more cyclical business model, then you value it in a different way. So to that extent, you really need to pick and choose different frameworks for different sectors, for different companies. I think that's more important.
So what I'm hearing is,
in my case,
yeah.
I want to know that a company is going to deliver X amount of profit growth in the next 1 to 3 years. So typically 2 to 3 years is what we project overtly, and then there are of course long-term assumptions based on our own judgment. But more importantly, what I typically like to do is outline at the time of investment, pretty much mark out which are the milestones we are looking at. So, for example, as I said, in the case of this bank which is growing consistently, I don't need to have any event which I need to track. I just need to track the quarterly results to see whether broadly things are on track. But suppose there's let's say a chemical company which is in a growth phase. Then it's making good money today with 50% capacity utilization. Maybe next year it's going to 80% capacity utilization based on the order book. But then it's going for capex, and he's going to use this current cash flows to fund his capex. So then I like to see what is the delivery date of that capex. What is the utilization of that capex likely to be? Whether he'll have clients for that additional capacity when he comes through, and that event is something I would mark out in my calendar, and then as we come closer to that event, check back with the company whether to check whether things are on track. So I need a tracking of triggers and milestones for growth also.
Wow.
That's what we kind of typically try to do. 2 to 3 years is the time frame we try to map out. Beyond that, of course, is very difficult to figure it out, and then keep on revising the projections as different milestones get delivered.
Yeah. So I guess it's true of any style. You have to be very deeply involved.
Let's put it, growth at a reasonable price with a strong focus on quality, with visible growth drivers and or growth triggers.
Yeah. So now you are, of course, a money manager. So the question I'm asking now is keeping the individual in mind, right? Typically, how many stocks should there be in a portfolio? Like when you're constructing your portfolio, so I guess there's a fund angle and there's an individual angle. How many stocks would you have? And are there any other parameters you look at? Some are like very long-term focus, some are little interim, or some people, let's put a bulk of it in the index stocks, safer, a little bit in the small caps, longer. So talk to us about how you would go about constructing a healthy stock portfolio.
So for my institutional portfolio, typically 40 to 50 is the number that I like to keep. There's a bit of a tail always because there are some stocks entering and some stocks
40 to 50 stocks.
40 to 50 stocks. As an individual, I would say you don't need to own more than 20 stocks if you already own some mutual funds, etc. In any case, that will give you adequate diversification. But again, as an individual, you need to be very sure as to what you're buying, and you need to have an edge over others when you're buying the stock. So if you are, for example, a person in the chemicals industry, and you come to know of a supplier or a chemical company who you actually do business with, then you have probably a better understanding of that business than me, right? And then if you own a stock, then you might as well do it with more conviction as long as you are closer to the company.
Yeah. So related to this point on portfolio construction, I think one of the things that people underestimate is the importance of allocation of how much money you put into each stock. Very often what happens is that you got these, let's say you got these 20 stocks. Some of them are going to be underperformers. So either you are equal weighted, or as luck would have it, or bad luck would have it, you have a lot more money in the stocks which are not done well, which probably are the mainstream darlings, and after a while they peter out. How do you go about allocating money to stocks? Is the conviction, of course, I'm sure you don't do equal weights, right? What goes into that decision that in this stock, maybe I need to take double the normal weight that I would take, or in this stock, I need to take less weight because it may be more risky?
As an institution or as an individual?
Talk to me about both.
Okay, so let me start with the institutional part first. Typically, long-only institutions like us, whether it's insurance companies or mutual funds, they do have a benchmark to beat, right? Whether it's a BSE 200 or the Nifty or the mid-cap benchmark, but there is a benchmark. So most of the bets, take into account whether a stock is there in the benchmark or not, and of course, how much is the weight in the benchmark. So sometimes I see, oh, this fund has 10% in Reliance. That's a lot of weight, but that's not the case, right? Because the benchmark weight of Reliance itself would be more than 10%. So the fund manager is actually not saying that he's bullish on Reliance. He's just saying probably he's neutral on Reliance because it's such a large stock. So to that extent, the style is being benchmark aware, and the bet sizing depends on the conviction. So if a stock is 9% in the benchmark, and I own 6% in my portfolio, it's not a positive statement. It's a negative statement, right? Because I'm underweight 3%. And to put things in perspective, having a 3% underweight is a big bet. Because if you're saying that a typical stock would outperform or underperform the benchmark by say 10 to 15%, 15% outperformance of a stock in which I'm underweight in a year would mean I lose almost 0.5% versus the benchmark.
Wow. Yeah.
Yeah. And typically I've seen that fund managers globally and in India are expected in a good year to deliver say 200 to 400, 2 to 4% more than the benchmark over the long term, right? That's the expectation.
Yeah.
I mean, more is better, but then you have to take commensurately larger risks also. So I've seen over the long term, if a fund manager is doing 2 to 5% more than the benchmark, he's a good guy. He's a good fund manager, right? So losing 50 basis points on one bet is actually losing 10% of your target outperformance in a year. That puts things in perspective, right?
Now it hits harder when you say it like that. Yeah.
So if I have a budget of 4% outperformance, 50 basis points loss against the benchmark is 12% gone from my yearly target, right? So that I hope clarifies things the way we look at institution.
Yeah. Yes. Yeah.
If a stock is not in the benchmark and I own 3% in that stock, it's actually a 3% overweight.
Yeah.
So owning 6% in one stock could be a 3% underweight, and owning 3% in a stock can be a 3% overweight. So that's the way we look at things.
Okay. Well, and talking about individuals, what do you think of individuals in terms of weightages in construction?
Yeah. So in individuals, I think the first thing that you need to worry about is loss of capital. Right?
Safety first.
Individuals, you don't care what the Nifty is doing, right? You want to make absolute money. In individual, the targets are typically more absolute. And there, the first thing to think about is not to lose money. Which means that if you own stocks in a sector which is either overhyped, too expensive, or leverage sectors like the infra real estate sectors that we saw in 2007, 8, 9, there is a serious risk of losing all your capital. The first thing to do as an individual is to avoid loss of capital, right? And then I think do or invest in stocks where you have an edge or you know something about. And of course, or you invest in the large stocks which which are
the blue chips, and just ride them over a long period of time.
But then you might as well put money in a mutual fund. It's more tax efficient in any case.
Yeah, that makes sense. So okay, I hear you. I think one thing we all will appreciate is how complicated the life of a fund manager is when allocating money. It may look simple from the outside, but it's a lot more complicated. Talk to us about your rules for selling a stock.
Sure. In fact, that's something that I'm very proud about in the sense that typically some of my best decisions have been sell decisions rather than buy.
Okay, very interesting.
And I think that comes from a bit of a mindset where I try to consciously avoid getting attached to stocks or companies or sectors or even promoters. Some of the promoters, because as a fund manager, as an analyst, you get to meet so many promoters, and most of them are smart people. Obviously, they are smart because they are successful, and they're successful because they are smart, right? Okay. And most of them are good communicators, very impressive, so to say, and most of them have substance. But that substance, boils down to the fact that a good company and a good management does not make a good stock all the time. So ultimately, if a company is good, but if it's trading at horribly expensive valuations, does not make it a good stock. So trying to detach the company and the personality of the promoter and the management from the stock price is something that I consciously try to do. And to that extent, I also make sure that I don't get too involved with any management or any company, so that it becomes a bit difficult, awkward sometimes if you are too close to a person, so to say. So it's keep the distance, try to be objective, and what I typically do is we don't sell in one shot, because there's always a range, right? What is expensive at 25 PE is also expensive at 35, is also expensive at 45. So just because the markets are trading at say 15 PE and the stock is trading at 25 PE makes it expensive, yes, but that's not the only reason to sell. It's not the arithmetical formula, because I might be underestimating the growth. So we are also revising our estimates all the time. B, I might be underestimating the fancy that the market has towards the stock. Sometimes there's a problem of being too early also. You know? So to that extent, we internally we give graded ratings to stocks from a strong buy to a strong sell, and try to kind of align the ratings with the bets. So if in our view a stock has 50% upside, we would give it a certain amount of overweight, compared to a stock which we believe has 15% upside, then we'll give it a lesser overweight. Similarly for the underweights. So we try to kind of grade it. And as I said, we started off with a say 3% overweight position in a stock. And then as it starts getting relatively more expensive, we try to pare down, rather than all in one shot. And again, sometimes people ask, what is your absolute level to sell? I said, there's no absolute level to sell, because we are all in the relative game, especially us long-only fund managers. We are in the relative game. So when a stock has gone from a PE of 15 to PE of 30, it's also probably the fact that the market PE has gone from 12 to 25, right? So has the stock become expensive in absolute terms? Yes. But has the stock become expensive related to the market? Probably no, because the market itself has gone up that much. So those are the nuanced kind of decisions that we have to make. And that's why we try to do things in a staggered fashion rather than all in one shot.
So you're saying in your sell decisions, you try and keep the emotion out. You're just focused on the substance and nothing else. And you're selling staggered, which is a great hedge, right? We are basically saying, let's not treat the market as dumb. Maybe the market knows something we don't know. And then you can exit gradually over time, as again, just selling a flash sell order.
Exactly.
And I think that makes sense, right? For an individual, it may be a little more mental gymnastics, to not sell all at one go. And also a lot of the paperwork and, putting in orders regularly.
One big advantage that institutions have, especially insurance and mutual funds, is that we don't have to worry about capital gains. An individual, when he sells, he has to worry about whether it's a long-term gain or a short-term gain or a speculative gain, that kind of thing. We don't have to worry about that. So we can actually just take a call based on the price. So that's
the late Mr. Jaitley introduced us back to long-term capital gains tax. Otherwise, life was much better for most.
Exactly.
For a long time, there was no tax, right? Long-term capital gains.
Exactly.
I think Mr. Jaitley introduced that, 10% or whatever. I don't want to put you on a spot, but any examples you can share where you could exit ahead of time, where your process of selling a stock worked?
So, as I said, typically we tend to do things in a staggered fashion. That's the way it works. So that size also matters. We don't want to disturb the price immediately, but we do take strong calls when there is an adverse development. So if there is some issue which has cropped up, etc., then we took very strong calls, and you get out in one shot, so to say. Similarly, from buying also, we try to buy it in a staggered fashion. But if there's a material development which we do believe that can impact the stock price more rapidly than we thought, then we try to buy more aggressively also. So case to case, but by default, we try to do it in a staggered fashion.
Sure.
So some of the sales that have worked in the past, as I said, was one of the biggest sales that we did was getting out of infra and real estate in between Jan to March of 2008.
Oh, that was really the peak, I think, if I remember well. Yeah.
Let me get it. Between, I would say, October to March 2008.
Okay.
So October 2007 is around the time when I thought things were getting a bit wonky. Especially, you had enough indications from the US markets about CDSs, facing stress, and things here were going wonky. So from July onwards, I was getting nervous, and by October, I was getting really nervous about the way things are. So we actually did not participate in a lot of the upside, the last blowout upside. So for a few months, we did underperform. But in January, we actually doubled down and sold more. So we kind of took the underperformance from July 2008 to almost January 2009. But then it all got covered up within a period of a few months. And
Yeah.
it was one of my best years.
That's a great call to have made, right? It's one for the books. If you're writing a book as yet, or have you?
Yeah. So in fact, we were quite well timed. There was a bit of murmur from the salespeople. I was in a mutual fund at that time. Last few months, underperformance, etc. But we stuck to it, and that turned out right. So sometimes you have to consciously be aware that you are going to face some pain for the next few quarters or few months, but it's all for the good, long-term good.
Yep. Moving to asset allocation, I'm talking individual now. One of the beliefs we have is that in the long term, the role asset allocation plays in your wealth generation is far more than what one assumes. A lot of people think that just picking the right stock is the ultimate solution to building wealth, but it's also about allocation. How much stocks you buy, how much gold you own, how much property you own, etc. Tell us about your thoughts on asset allocation, and also if you can share, how do you go about your asset allocation process?
Sure. So I think you nailed it. Asset allocation is the key variable for long-term wealth creation. Picking stocks is important, but you really need to be lucky. So if you don't want to bet on luck, then the other option is asset allocation.
That's helpful, yeah.
So we are all bright people, right? And if somebody told me in 1994, when I thought finance was the place to go, but some of the other colleagues who did not get good placements actually then joined software companies, right? So, and the rest is history, right?
The rest is history, yeah.
So some of the batchmates, for example, in 1994, 95, in fact, 1994 was a decent year, but 95, 96, 97 were bad years for recruitment, campus recruitment especially. So at that time, all the finance jobs had dried up because of the Asian crisis, etc. And a lot of people were forced to join software companies. And the value of those options that they got by default is far more wealth than I've created. At least I know for sure.
Yeah.
So you need to be lucky. But as I said, if you don't want to bet on luck, then long-term asset allocation is the only way. And in a country like India, as I said, with nominal GDP growth of double digits, it makes sense to be in equities for the long term. The younger you are, the more equities you should own.
Yeah.
If you can't manage your portfolio on your own, which most of you won't be, because again, you have a full-time other job, not necessarily financial services, then go for the mutual funds or those kind of calls rather than trying to day trade.
So I'm sort of pressing on that same question. So when you are looking at your own asset allocation, how do you think about other assets like property and gold and silver? Do you allocate to those? Do you not? And what are your thoughts on that?
So as of now, I think for an HNI, for example, commercial real estate makes a lot of sense.
Okay.
So depending on the ticket size, I think in residential, the yields are not that great. But commercial real estates in India, even good quality estates, are yielding a good amount. So I think there can be a core element of commercial real estate in a HNI's portfolio. Gold, I used to be a fan, but the way it has performed in the last 2-3 years, I'm not too sure anymore.
It's shaken many people's confidence.
Yes.
Yeah, last 2-3 years. It's
Yes.
amazing. One would have thought that this was gold's moment, right?
Absolutely.
Just completely disappointed. Yeah.
My guess is that a lot of money which could have potentially gone to gold this time around went to the crypto.
Yeah.
Because that did very well, but of course now they're down. So hopefully gold will be more stable going forward. But that's been a disappointment. I would have logically thought that with this kind of inflation and this kind of pump priming and money printing, gold should have done much better. But commercial real estate in India, I think, makes sense. Globally, I think real estate is bursting, but not so in India, because yields are still decent and there is good supply demand balance. There is no oversupply in the commercial part. So that's one thing that one can definitely look at. AIFs, especially PE, VC kind of investments.
When you say AIF, you're referring to alternate investment funds.
Investment funds is not the listed equities. I listed, you might as well go to mutual funds or insurance ULIPs. But asset classes like venture capital or private equity also can have some space, not very large, but some space in your portfolio, just for the sake of diversification and to get exposure to some of the newer emerging trends, so to say.
Yeah.
In fact, as insurance companies, we also do invest in some AIFs. And that's given us good insight. Of course, we're happy with the returns, but it's also given us good insights into some of the emerging portfolio companies and emerging sectors, which typically are not available in the listed space.
That's interesting. Yeah. The newer technologies that are coming up, or the newer business ideas that are coming up.
Yes.
So as part of your allocation, in fact, sorry, I missed asking you, what about global stocks? Do you think about global stocks?
A couple of asset classes which we missed out, again, relatively new, is REITs.
REITs, yeah, of course, yeah.
And Equities. Those are also coming up in the last 2-3 years. And on a case-to-case basis, they also make a lot of sense because there are always instances of mispricing. So REITs are a yielding asset typically, but then the share price of the REIT keeps on going up and down. So at one point in time, REITs were giving you a yield of almost 7-8% with a potential for capital appreciation also over the longer period of time. So they also make sense in a diversification world.
Yeah. Global equities, anything?
Global equities, if you look at the past 10 years, NASDAQ has been king. But if you look at the 10 years before that, Indian markets were outperforming everything else. So there is always these phases. So if you're in India and your assets and liabilities are in India, then typically you want to have a much larger chunk in India itself, because that's where your expenses are going to come from. And as I said, rupee to rupee, nominal GDP growth in India is much higher. NASDAQ has, of course, done very well in the last few years, 10 years. Of course, last 1 year has not been that great. So a little bit of diversification is fine. But again, with India, you know what you're buying, right? You know the ground. Whereas in the global markets, you all obviously are not that much in touch.
The more unknowns.
The more unknowns. But if I in general look at global markets, I would still go for the specialized kind of investing, like tech investing. Say the NASDAQ makes more sense because that's global in nature, right? It's not dependent only on the American economy. I'm still a fan of technology, of course, at a price. So if the NASDAQ corrects too much, which I think will happen in the next few quarters, then again it would be a good time to look at it. But as far as
growth at reasonable price for you, so your domain.
As I said, NASDAQ and the tech companies, I would buy for the innovation, for the cutting edge stuff that they do globally, not for the American economy. If I were to bet on an economy, I would still bet on India.
Okay. Wow. In terms of cash, how many months of expenses of cash do you keep aside for meeting emergencies and just paying bills, etc.?
I don't know. I've never thought about it like that. Probably because of my socio-economic level, I really don't think about that in those terms.
How much to keep aside? Okay, yeah, that's fine. That's fine. Okay. Before the podcast, I asked you. So one of the big things is that you're building all these assets. You're thinking about accumulating a certain amount of wealth to take care of your needs and your kids' needs, etc. But at some time, you're also thinking, I have to hand this over to the next generation to manage, right? So talk to us about how are you teaching your children and how are you exposing them to money and investing and planning? And tell us, maybe share a few incidents of how it went.
Yeah, I think as far as kids are concerned, I have two. the best way to teach them is to let them absorb it rather than telling them this is it.
Show rather than tell, no?
Yeah. So I mean, I'm sure they absorbed a lot, because I think the typical image that they have grown up with is me walking at 7 o'clock, coming back home with a phone in my hand and continuing the conversation till 8 o'clock and then going for dinner. So I'm sure they've overheard a lot of conversations on stocks and companies and global economy and whatnot. So they've absorbed a lot. So my son, for example, is in the US, and he's earning his own salary now, doing a job there, and he's on his own now, started investing in a few stocks by himself. Dabbled in Bitcoin. I don't know how that's going, but
You said dabble in Bitcoin.
Dabbled in Bitcoin also. I don't know how that's going. I didn't
Like
ask him.
all youngsters.
Yeah. But yeah, he's also using his own experience and trying to identify trends and picking whatever little money that he has, putting money into stocks. So I think he's getting there. My daughter is studying economics. She's in college, so she doesn't have spare money as of now. But she's decided to do economics. I guess that'll somehow lead her to the markets at some point in time, I guess.
Yeah. Okay. Here's a question I ask all my guests. We've been through the pandemic. There was probably a 1.5 year period you didn't go out, didn't go on fancy holidays, fancy restaurants. So your wife comes to you and says, "Hey, Mihir, I saved 1 crore rupees in this last 1.5 years, and it's lying in my cupboard. Now, what do I do with this?" So what would be your advice to her?
Well, she's already using it. We already started using it a lot. We've done quite a few trips already since July of this year.
Okay.
So that excess is getting depleted quite fast.
Spending money is for spending only. No, nothing else to be done with it. Okay, that's nice. That's nice. That's if you're traveling on holidays at these points in time, it costs a bunch.
Yeah, that's what
everything is very expensive. The flights, the hotels, everything. Oh. Well, let's see how that cycle goes, right?
And some of the trips were foreign trips, so the rupee also hurts.
Rupee hurts, yeah. Okay, your thoughts on giving away wealth? Have you thought about that, or how do you think about that? Too early? Thinking about in the future?
I hope to get to that level where I actually have to think about giving away. So as of now, I'm still building my corpus, especially with the kids studying abroad. That's a lot of dollar expense per year.
That's right.
Kids into 4 years, so that's 8 years of dollar-based educational and living expenses that I have to provide for. And this is on post-tax rupee earnings. Let's put it that way.
Post-tax depreciated rupee earnings.
Exactly. So yeah, we got some planning to do there, and of course, in the tax bracket that I am, there is a lot of I'm giving back to society in terms of taxes, income taxes as well as consumption taxes, I'm sure. But yeah, at some point in time, one needs to give back to society. For example, my wife very actively worked for a non-profit for a pro bono for 5 years. She was there, build up a good work, good kind of framework there, and so not in monetary terms, but in terms of effort, it was a lot of 5 years of effort from her side. She's a software engineer who gave up her career to manage the kids quite a few years ago, but now that the kids are no longer here, she's spending time, whatever she can, on giving back to society. So not in cash, but in kind. Definitely, we are beginning to give back to society, and I would also like to do that at some point in time.
Nice. Was she one of the software engineers who graduated in 1995?
Yes.
So all the options are still there or not there?
Yeah, some of them. Yeah.
Some are there. Wonderful. Very nice. Okay. Now, talking about India. Right. You mentioned multiple times about your, I guess, your preference of India over, you mentioned about over the US, for example, or over, and the other thing you've spoken about is that India's got a growth trajectory and this is where you want to be. So, we've been through this multiple times, right? We've had the reforms in 1992, the Manmohan Singh, PV Narasimha Rao reforms. and people thought India's moment had come, and it proved to be a false start. And we've had a couple of more false starts after that. So talk to us, what gives you conviction that this time it's for real, and one can actually see a 10, 20, or how many years you see a growth trajectory, and that's why it may be the right time to really look at India even more seriously than how people have looked at it in the past.
See, I don't think we need to worry about whether it's this time or not, because we've had since 1991, right? We've had different combinations of governments. We've had different kind of geopolitical issues. We had Kargil, and we had Pokhran, and we had the Mumbai attacks, and every time it used to be a disaster kind of a situation where people thought. But over a period of time, we realized that, and then we had the Galwan issue, we had Demon, so many things we have gone through. But the good thing is that now we realize that India is so huge as a country that even if there is a disturbance in one part of the country, it does not impact the GDP growth, right? It makes headlines, yes, it makes negative headlines for sure, but it does not change the way things are. Things move on. The demographics, the inherent momentum that is there because of demographics is there. Plus, investors globally also have gone through the learning curve, right? Till 2 years ago, China was supposed to be the market, right? But if in hindsight you realize that the Chinese markets have given you zero returns for 30 years. So, as I said, a good economy does not make a good stock market, right? Like we said, a good company may not mean a good stock.
Yeah.
So, just because China has grown at 9-10% for the last 20 years does not mean that investors made money in China. So it's not only about growth, it's about transparency, it's about values, it's about disclosures, rights, legal system, and all said and done, we are still a democracy, and a relatively open democracy, free market. Whatever controls we have are all overt controls. We don't have any hidden controls, right? So equity money can flow in and out of the country very easily. Debt we have controlled because there are different reasons for that, good reasons for that. But equity can flow in and out of the country. If you look at the top 200-300 companies in the listed companies, the governance and all is pretty okay. SEBI has done a great job. Legal framework has proven itself again and again. We have the NCLT framework now. So I think a lot of progress has happened on the policy side. Our exchanges, stock exchanges have withstood the worst of crisis, worst of meltdowns without any breakdowns, right? So our clearance settlement mechanisms, the trade guarantees, the margining system that we have on the stock markets, RBI is doing a great job. So I think in general, there is transparency. There are functioning institutions like the judiciary, the exchanges, the RBI, the government. And now it looks more and more like, India might get the tailwind also of China plus one, Europe plus one. And it also coincides with the fact that in 2019, the government realized that we need to cut corporate taxes. So in September 2019, we announced lower corporate tax rates for new investments. Then quarter after quarter, we are adding more and more industries to the PLI scheme.
Yep.
So they're pretty much now all the industries which are either import substitutes or export potential industries are being covered under PLI, right? Second is government is dead serious about indigenizing its own procurement, especially in defense. And willy-nilly, it's coming around. So to that extent, I think the fact that India has now proven itself, China has kind of been notched down a bit in investors' mind. Definitely, people are going to give it a second thought when they are investing in China, the way things have gone in the past few years. And India has proven itself again and again that forget the economy, the stock markets have returned good returns for global investors.
Yeah.
So I think the PE experience in India, the VC experience in India, the portfolio investor experience in India has all been positive. Whereas it's exactly the other way around in China. China, they have shut down companies, arrested managements, companies disappear, managements disappear. They regulated the education companies, they regulated the tech companies one fine day, and all of them are down. It's 80%. So there is no transparency. You don't know what you're doing out there. So I think India will get a tailwind of global flows after all this choppy episode is over. And that's what makes me so bullish on India.
In fact, one of our recent guests on the podcast said this, that India's moment has been brought forward 5 to 10 years because of what's been happening in China.
Absolutely.
Otherwise, we would have taken a lot more time to get a rightful share in the global money flows and manufacturing and all that. But after what's happened in China, everything is like, now these are my words, on steroids. It's happening a lot faster. So I think so when I, if I was to think of it, it's like the trigger for this phase of growth in India has been the devaluation of China in the minds of the global money managers and the global business people. They suddenly realize the risk of being involved. So now they're looking for new destinations. And the other part of it is that India has done a whole bunch of things in the last several years, which are cumulatively sort of shining a much better light on us. So when someone's looking for money, and here we are sitting with all these things starting to fall into place, I think it just adds up and gives us probably a tailwind, like you mentioned, which could be fantastic.
And the government has basically woken up to the fact that we need to do this. And it's not only the center, but now you have debates like people in Maharashtra cribbing, oh, this project went.
Yeah.
Yeah, it's a problem for Maharashtra, but it's a very healthy debate.
Competition is good. Yeah.
It's a very healthy debate.
Yeah. The states should want industry. They should debate. They should offer all that. And you're right. In 2019, was it 2019 when Nirmala Sitharaman started having monthly meetings, press conferences to announce new benefits? Was it 2019, right?
The corporate tax rate cut came into September 19. Yeah.
19. Yeah. They were having those monthly meetings to try and boost industry. So yeah, it's adding up. So what kind of a runway do you see? Yeah, like, do you think about it like this could be a 10, 20, like in China, it was a 30-year thing, right? 90s, 10s and 20s. For 30 years, China just grew like crazy. Do you think that India has that kind of potential and the kind of thinking to be able to pull this through?
I think so, because I mean, on a per capita everything, we are so low that it's for us to mess it up, frankly.
Yeah, I like the way you put it. It's for us to mess it up. We have if you go by the basics, you need land, labor, capital to produce. We have enough resources, enough people, and now there's no dearth of money.
We have enough resources, we have enough people, capital will not be a problem, right? And we have a market, a domestic market, which is ready.
And now you've got all this, the tech stack, which helps you reach the market much more seamlessly and allows you to service a lot more cost efficient.
We are light years ahead in some of these things,
Yeah.
Because as I said, my son is in the US, and we wanted to transfer money from his account to his credit card, and he did it on a Friday, same bank's credit card, and the bank said the credit will be reflected after 2 days.
Mm-hmm. Wow.
So, and India, it's like instantaneous.
It's RTGS, right? I think the RBI governor was talking the other day, 24/7.
This credit card of the same bank.
Yeah.
It should actually happen instantaneously. Those kind of late years ahead in some of these things.
Wonderful. Okay, moving ahead. Talk to us about what do you read, and how much time do you spend reading?
I mean, I'm so lucky to have a profession where you get paid to read, right?
That's right.
When you actually step back and see what we do as investors, as analysts, it's basically reading stuff and talking to people, and talking to good quality people. You're typically talking either to your own analysts, or sell-side analysts, or investment bankers, or corporates, or policymakers. So it's a very high level of interaction that you are able to do as an institutional investor, and I'm completely grateful to my job that I'm in a situation like this. So reading is something that, whether it's emails or social media or books and magazines, I would say it's a 24-hour process. In fact, sleep patterns sometimes tend to get disturbed because you're reading the glowing screen for too long, and they say it's not good. They say it's not good for sleep.
You're a Twitter buff. I've seen your posts on Twitter. Very interesting, and you're always posting. So and they're very intriguing. So I can imagine how much you're reading and keeping track of to be able to post such great stuff.
Yeah, so I'm reading all the time. I must admit though that my over the past 4-5 years, the long form reading has reduced and the short form reading has increased because of social media. So that change I can see. The thing about social media is that it gives you so many various perspectives in a short period of time. So earlier, you probably were following 3 or 4 global strategists very closely, and 4 or 5 local analysts or strategists very closely. But now you're like 20 good people to follow, and you have 30 good people to follow for say politics and also. There's a bit of a filtering that you need to do. As I said, the long form reading has gone down a bit, and the short form reading has gone up, but I think it's all for the good.
So we are of course recording this show on the 8th of November. It'll get published later. But are you in that camp where you're willing to pay $8 to Elon Musk or no?
I don't think so.
Oh. But that's a question that had to be asked because that's the question everyone's being asked. So I thought I should not be left out. I should ask you that question.
Yeah.
Someone did a calculation the other day.
Very well, that if you paid $8, knowing that everybody else will be able to get that verified tick by paying $8, then does your verified tick hold any value?
Well, yeah.
Yeah.
So apparently someone was doing this calculation that the rate for India is going to be like 199 rupees or something per month. Because they're going to adjust it by purchasing power. So probably, Mr. Musk is in for a surprise at how many Indians get the tick, I guess.
Might get tempted, yes.
Might get tempted, yes. Any recommendations that you would like to, or any just generally, as we are coming close to the end of the podcast, your thoughts and suggestions to our listeners and viewers on what they can do to just become generally better wealth creators and wealth generators.
The last topic that was read a lot, and we are lucky to be in the age where we have so much information to read, to check it out. Find a few good people to follow on social media. I think that's invaluable, and information is so widely available that you can have n number of websites where you get getting data on fundamentals, on technicals, on all sorts of things. So I think even if it's 100 rupees, put 100 rupees into a stock and start analyzing it, because there's no better way to really get into it without investing. You can read all the books that you want, but till you make money or lose money, you will not know who you are as an investor, and everybody's different. And the earlier you start, the earlier you discover what works for you, what doesn't work for you, the better. So even if you don't have thousands of rupees or lakhs of rupees, buy one share of anything that you analyze, and then watch the share price over a period of time, see what's working, see what's not working. Just there's no better way to learn this than jumping into the water and try to swim.
Having a little skin in the game just takes you on a different path of learning.
Absolutely.
It's a little more involved. Paper trading is good, but you don't really go through that emotion, but you have to keep in check. Stick to the substance, not the emotion, right? So
this is one area where you can fool anybody else, but you can't fool yourself.
That's right.
The market price is the ultimate truth.
That is right. You can tell the people all you want at the cocktail parties, but at the end of the day, you know what you've done.
Exactly.
So on that note, Mihir, thank you very much for your time. It's been a wonderful conversation. I've really enjoyed our talk. I loved the way you spoke about selling. I think we've spoken about selling in most of our episodes, but the way you explained it was very interesting and intriguing. I love the part about staggering because it sort of de-risks your selling process, and so many other nuggets. And I'm sure our viewers and readers will love it, and we'll get all the feedback, which of course I'll pass on to you. So thank you very much for taking the time out to do this.
Thank you, Rahul. Pleasure to be here. Thanks for spending so much time.
Thank you.